Welcome back, everyone, to Vox Markets Live. My name is Paul Hill, and I'm delighted again to be able to speak to expert analyst and all-round star stock picker Paul Scott to talk all things small cap. So welcome, Paul.
Thanks, Paul, and hello again, everyone.
Yeah, well, we've had lots of corporate news this week, plus Trump has been promising to tariff the socks off China, Mexico, and Canada. So just big pictures. Anything sort of particularly caught your eye this week on a sort of like a macro front, or anything of note that has been different?
I think reading all the trading updates, it seems to be a much sort of softer overall economic climate at the moment, doesn't it? We definitely are seeing this soft patch triggered by all the budget uncertainty, but I'm hoping that should pass reasonably quickly. I don't think there's any reason to expect the economy to nosedive, but we're definitely in a bit of a soft patch at the moment, and the expected upturns in a lot of sectors are just not really happening, are they, at the moment?
Yeah. One thing that has really sort of like come to the forefront, even more so than the last 6 months, and it has been running quite hot anyway, is M&A. We had sort of takeover Thursday.
Yes.
I mean, we had obviously Loungers being taken out, Renewy. We also got a bid for Direct Line from Aviva, and then this morning we had that completed deal for TI Fluid. And it just seems as though it's gone bonkers before Christmas with takeovers, suggesting to me anyway, there's real value in this sort of small mid-cap area.
Yeah, I totally agree. I mean, everybody's been asking, well, what's the catalyst? What's going to get UK small and mid caps going again? And we know the answer now, don't we? It's takeovers, as you say, 4 of them in the last 2 days. Seems to be more focused on the mid caps, doesn't it, rather than the tiniest stuff. Yeah, so that's your catalyst. And I think cheap markets just attract money in, either private buyers saying, well, look, we'll leap in and pay 30 or 40 or 50% more for it, premium, and they still think they're getting a bargain. So that shows you just how undervalued a lot of these stocks really are. So rich pickings. I'm really excited. I've been buying a few more things myself this week.
All right, we'll go through those in a moment.
Yeah.
Because I think you're exactly right. I mean, it kicks off with obviously professional buyers of private equity or trade buyers coming into the market, giving cash into the hands of active fund managers in the small and mid-cap sector, who then have to redeploy those funds into other companies, into a smaller market. So that will push them up as well, to improve the valuations. And then I'm hoping the third part of that sort of leg is going to be in earnings increasing next year. I mean, we've been promised it for a long time after a bit of an earnings bear market in all things small cap. But if we get that third piece as well, and that should really jumpstart small caps.
I think you're right. I mean, with the last few weeks conversations we've had, we've concluded, I think, a lot of the selling is just liquidity driven selling from fund managers who are having to meet redemptions. So every substantial takeover bid you get that comes through gives them a shot in the arm in terms of liquidity. So it gives them, as you say, money to deploy buying other things, and it means they can meet redemptions maybe out of the takeover bid proceeds, and it improves their performance stats. So they're less likely to get further redemptions if they can show good, strong performance. So I think it's exactly what the market needs, although it is a pity, isn't it, to see lots of good companies leaving the market. But I think it's a means to an end. It fills that liquidity gap, and it brings a bull market one step closer, I think. So yeah, I'm very, very positive about things, really.
Yeah, I totally agree. If anybody wants to ask Paul any questions or myself, then please put them into the chat bot, and I'll read them out. That's no problem at all. Also, I'd just like to quickly say a shout out to our sponsor, Good Money Guide, again. In fact, they're running a nice little competition for Christmas, so you can win a £500 into your junior ISA if you put a review on their page. So please feel free to use that. You get yourself a nice sort of like Christmas present there. 500 quid's is pretty good for everybody. Just on that M&A, I know, Paul, that something which has struck you, sort of piqued your interest, is ITV, the sort of obviously the terrestrial broadcaster, but it's also got a very attractive studios business, hasn't it? And do you want to take us through what you see there?
Yeah, it's a bit outside my usual size, but I'll look at anything, irrespective of market cap, if I think the numbers look good. I've covered ITV 2 or 3 times this year, doing just quick reviews of it. And earlier this year, it mentioned that its pension scheme is now fully funded, which I thought was a very positive message. Um, I just think it's one of those businesses that has pretty obvious strategic value, and when bid talks crop up every now and again with ITV, and that's what drove that increase from 67 up to about 72p, was a bid speculation. So it could be somebody who's looking to start a rumor to, create some buying interest in it, maybe. But I think it was Sky News, wasn't it, who broke this, and they included some very detailed named names about parties that had approached it and were negotiating to buy specific parts of ITV. One of which was, I think, the French, a major broadcaster in France, and one of them, at least one, maybe two, were financial buyers that were named by Sky. And as we know, I call it the SNS, the Sky News Service, seems to be where we get usually, nearly always, reliable, accurate information ahead of the RNS. So anything on Sky News, I tend to take quite seriously. And I like ITV on fundamentals anyway. I think it's good value.
Well, just in terms of their split between, I mean, what's the valuable part? Is it the studios, or is it actually because the terrestrial TV, linear TV, has been struggling for years?
Yeah, I don't know, Paul, off the top of my head. I mean, I'm just looking at it as a whole, and I think the figures for the group as a whole look attractive value. They did mention that they were having still some hangover from the Hollywood strikes, which seems to have left quite a long tail of disruption throughout the TV and film industry. But yeah, looking at the Stockopedia page for it, 2.8 billion market cap, forward PE is only 8 times. You've got a dividend yield of 6.9%, and I've got a feeling it might be doing buybacks as well. So it's more my sort of value investor antennae that got twitching by those numbers than anything else. I'm not claiming to have done any massively deep research on it. I just think it's worth flagging to the viewers as something they might like to do some more in-depth research on.
Yeah, no, I would agree. I think certainly if you look at the studio side of it, it's got great sort of acclaim around the world, and a lot of sort of like on streaming people, streaming bodies actually use it as well. So yeah, I'm with you. There's a lot of value, and the back catalogs were obviously worth quite a lot as well. So
that's a good point. Yeah.
There's definitely value. Okay, good. Just staying up in that sort of like mid-large cap, we've got Kingfisher as well, which I know has sort of piqued your interest. That one trades at roughly, I say, about 11 times. It's obviously owns B&Q, and it's got interest out in Europe as well, hasn't it? Like in France,
yeah, it's got quite a big chain in France, but it's also in Poland and I think possibly Romania. Again, not one that I've done massively in-depth research on, but it dropped sharply this week, didn't it? It had peaked at around £3.30 back in September. And now it's all the way down to £2.48. So I thought, well, I'll have a look at that, because I know it's a fundamentally decent business. Yeah, I think this was just an overreaction by the market to a fairly predictable comment saying trading was a little bit soft in October, but I think it had been okay in August and September. Well, one soft month when you've got a lot of political disruption in the UK and in France, of course, they're having difficulties politically as well. Although I always think, if you're going to buy a new drill, do you take into account the macroeconomic and the items in the budget? No, you just buy a drill because you need it, but anyway. So I think sometimes the reasons that companies and brokers put on reasons for things not performing as well as they might be are a bit spurious. But anyway, again, similar situation to ITV. I've looked at the numbers and I think it looks attractive value. Forward P is 11.1 times. Dividend yield is 5%. Only a very slight adjustment downwards to the forecast, barely registers on the scale, really. So just a very, very mild profit warning that I think the market's overreacted to. Now, there's an interesting other angle on this. I love looking at balance sheets.
Oh, yeah. Well,
Yeah, what I discovered with Kingfisher is that its price to tangible book is only 1.17 times. And within that, it's got 2.1 billion of unencumbered freehold assets.
Wow.
And note 15 to the annual report said that they're in the books at cost, not revalued, and that it said they'd be worth 2.7 billion. So book value is 2.1 billion. They said it'd be worth 2.7 billion, these freeholds, if they did a sale and lease back with Kingfisher as the sitting tenant. So that's basically putting up a big flashing neon sign to private equity to say,
Yes.
come and buy us and do a sale and lease
Mm.
back on our property. So I think there could be an interesting, wouldn't surprise me at all if private equity bid for Kingfisher. And I think just as it's a good solid company, not the biggest profit margins, but I think your 5% yield, your asset backing, almost one-to-one asset backing, low PE, moderate PE, I think looks attractive. Yeah.
Yeah, I would agree, and particularly if we get a sort of like an improvement in DIY and building
Yeah.
and construction, and I mean, let's be clear about it. If the government gets anywhere near its targets for new build houses, and obviously that's going to sort of like inject a lot of sort of activity into the existing homes as well, then then all in all, these guys are going to do very well up at that,
Yeah.
in regards to that cyclical upturn.
I agree. I think it's probably at a cyclical low
Yeah.
in earnings, and yet it's on a modest valuation at what could be a cyclical low. So I think that's very attractive. I mean, one of my themes that I'm developing at the moment is that the stock markets tend to think about 6 months ahead. Well, that's what we're always told, isn't it? I've never seen it measured. But so that means that companies, quite a few companies in household products, building supplies, all that sort of thing, are saying that they're not really expecting an upturn in demand till mid-2025.
Yeah.
Well, we should be 6 months ahead of that, which means we should be starting to get into these sorts of bombed out things now
Yeah.
or in the next month, which that's a focus of mine at the moment, initiating some new positions in things that I think are oversold that could be and should be beneficiaries of a cyclical upturn. Now's the time to be looking into those shares, I think, to get ahead of the curve. If you just wait till, yes, we know the economy is now recovering, you'll be too late because the shares will already have anticipated that.
Yeah, no, I would agree, and just a classic example of that. And we should just update, investors from last week. We talked about Auction Technology Group, which
Oh,
does
yes.
sort of like all the technology that connects thousands of auction houses around the world with bidders, and it just acts as sort of like the middleman. Well, they came out with the results this week, and strangely enough, the broker took estimates down, but the shares shot up by about 15% and have stayed up there. And I think that's a sort of like it's a bit of a relief rally, but also I think there's some short covering going off as well. I don't know what you thought about Auction Tech. Obviously, the shares they've been hit a lot before they went into the results.
Yeah, that's right.
Any thoughts? I know you did have a look at the company, didn't you, in your
I
analysis?
did, yeah. I wrote an article about this on the day it put its results out, because I thought I better look at this because I know Paul will want to talk about it on Friday. So, yeah, I spent a couple of hours going through the numbers. Excuse me. I was pleasantly surprised, actually. I have to say, I mentioned last week that I was a little bit skeptical about Auction Technologies, but actually, it's a nice, very cash generative business. The cash flows are real. A particular standout was that it's substantially reducing its debt. It showed the last 3 reporting periods, and it's taken a big chunk out of that debt each time. That's impressive, because I was previously worried about the very weak balance sheet with far too much debt. It's now into the sort of middle territory, I'd say, where yes, the balance sheet's weak, it's negative net tangible asset value, but this type of business doesn't really need assets, and it's got something like, correct me if I'm wrong, but I think it was around £100 million or dollars net debt, which is easily serviceable. It can pay that off in about 3 years. So I'm much more positive on ATG than I was. However, and there is a big however, it was essentially a disguised profit warning. I mean, Cavendish didn't just trim the forecast; they lopped between 8 and 10% off the forecast earnings, which means that it won't be generating any profit growth at all over the last 2 years and the next 2 years. So this is a mature business that is not growing its profits at all. So It shouldn't be on anything other than a low teens PE, in my view. It's currently on 16 times forward PE. I think that's high enough.
Yeah.
They've got to demonstrate that it's not a growth company. That's the problem. I think what they'll do, because they don't want to pay dividends, I think they'll do lots of acquisitions like they've done in the past to create the illusion of growth where actually there isn't any growth. So yeah, I think I'm not interested in this one really overall, but it was better than my preconception.
Well, I'd have taken 20% or 15% upside on a day, any day of the week.
Oh yeah, no, I mean, it's a nice bounce, but there's no fundamental reason why it should continue rising, in my view. But who knows? Look, we can't predict, can we? Markets do.
No, we can't. No, I think the only fundamental one is that it's the first time for about, I don't know, 18 months that actually the top line has started to increase, because at in the look forward they said that organic growth was about, I think it was 4 to 6% or something.
Yeah.
They've done the last 8 weeks, so people are obviously thinking actually the ship has turned now. We've gone through the tough times of art and antique selling, and so I think that people are looking at the broker notes and thinking actually that's really sandbagging, and we can move forward, because you do get some short covering, no doubt about it, and they did take the numbers down. I totally get it, but fundamentally wise, the top line now it has done in the last 2 months organically grow, but it's a show me story, isn't it?
Yeah, and as you say, I think was it Jefferies? I think put out
yes, they did
bearish notes on this, and they've ended up rather with egg on their face, I think, over that. But
yeah. What stocks did you say you've been buying and selling this week? Did you?
What have I been buying? I bought some Pets at Home.
Oh, okay, right.
This was a mid cap that again I think was oversold. You're getting quite a few of these at the moment where they will, put out something very mildly bearish, and the market, like Kingfisher, actually. In fact, I might buy some Kingfisher. I forgot about that one. I've bought 2 or 3 property REITs as well. I think property REITs are an interesting area for very high dividend yields. What else have I bought? Yeah, I've been on a bit of a spending spree this week. Oh, I got into Brickability.
Oh, wow. Okay, so yeah, building products.
Yeah, sort of drop shipping of bricks and other, quite acquisitive. Not madly keen on the balance sheet, but I think, again, because I'm looking to position myself ahead of this recovery in mid 2025 in the house building section. And I think the mortgage approvals were out this week as well, which were quite positive again. So the housing market's beginning to show signs of life again. So I think this is the time to be picking up DIY, big unit retail type shares, house, building products companies. So that's where I'm starting to focus at the moment.
Yeah, I'll just let you know on Brickability, the CEO there, Frank Haller, is absolutely top drawer. He's excellent. I know him from Michelmersh because he came from there.
Right. Yeah, I remember watching a webinar with them a while back, and yeah, was he the chairman, executive chairman, or did I get that wrong?
No, he's the CEO. The
CEO.
The chairman's a different guy. Yeah, no, he
right.
came over from.
Yeah, the CEO, he really struck me as switched on. He's exactly what I look for, just a hands-on entrepreneur who's reeling off all the facts and figures. He's immersed in it all. That's what I like.
Yeah, he's been man and boy in the sort of the brick making industry for, well, basically 40 years. So
right.
He knows his onions, that guy, frankly.
Yeah.
Okay, just in turning to Pets at Home, etc. What sort of piqued your specifically interest there? Because obviously we've got that CMA ruling still hanging over it, but the whole sector is so cheap at the moment, isn't it?
It is, yeah. I mean, I was weighing up between CVS Group or Pets at Home. And then the decision was really made for me when Pets at Home shares plummeted on what was a very mild profit warning and not really unexpected. It's easy to get these muddled up because we've had about 3 of these things, haven't we? They're all saying similar things. I looked at all the numbers. It's a real cash cow, this business is, and about 2/3 of the profit, might even be more actually, comes from its vets business, which, as you say, the CMA issue is a potential threat. But the readers, I was discussing it with my Substack readers, and they were saying its vets practices are JVs with private operators. So they're not one of these sort of aggressive corporate acquirers like Medivet and CVS are the two that are probably, if the CMA takes action, it'll probably go for the jugular with those two. And I was moaning recently about having to pay £2,000 to Medivet for some relatively just having some of my dog's teeth taken out and clipping its nails. I mean, the corporate ones are absolute robber barons, I have to say, and I think they should be. I hope they are slammed hard by the CMA. But it seems to me, and from what the readers have told me, that Pets at Home isn't in that category. So possibly, hopefully, it should be all right.
No, I must admit, I prefer actually the CVS group, and yeah, and the reason for that is because it has got greater exposure to the CMA review. I mean, it was an absolute darling. It's now trading at sort of half the price as it was before the the
it's very
investigation.
cheap. Yeah,
it trades at about, I think, if I remember right, it's about 8 times PE or something.
8 times, you're right. Although, Paul, bear in mind, it's got a lot of debt. So if you adjust the valuation for the debt, whereas Pets at Home is net cash. So I think that accounts for the valuation difference.
Yeah, albeit I think the net debt to EBITDA ratio is only about 1.4, 1.5. But the thing because if you turn the clock back for the CMA, it took a very sort of belligerent and overzealous role in terms of the Microsoft Activision and got a lot of global criticism. And just recently,
yes, it did, didn't it? Yeah.
And just recently, it's also got a lot of criticism from Westminster about getting its act into gear, because it's actually it's stopping entrepreneurship and business and the UK attracting global companies to the shores. So I suspect actually they're going to do something, but I think some of the wind's been taken out of the sails, and they've got to step back and actually be normal. And so the reason why I'm interested, I don't have shares in it, but the reason why I'd be interested is I actually think isn't going to be as bad as everybody expects. And these guys, once you get that clearing event, it'll do really quite well. And then the other thing, big picture, CVS Group only makes 15% EBIT margins. It's not exactly predatory pricing. So you have to pay vets, and you have to pay. If they were making 30% EBIT margins, I might take a bit more sort of thinking, okay, that's a bit much, but only 15%. That doesn't sound as though it's. I mean,
it's quite high, but like you say, it's not absolutely off the scale high, is it? But no, I mean, I suspect. I mean, look, we're guessing, aren't we? But I suspect they might come along and say, you've got to list all your pricing clearly and transparently on your website so that customers can compare and things like that. That might trim their profits a bit. But I suspect you're probably right. We're guessing here, but I think you're probably right. There could be upside on these vet shares from when the CMA, concludes.
Now I need your help here, actually, Paul, because you've got a nice jingle for stock of the week, haven't you? Isn't it? Which are like start.
I'm not doing it.
Okay, well, I'll do it. Stock of the week. Okay, that was an impression of you. But anyway, what I just want to do, my sort of stock of the week this week.
Oh yes, I know this one. Yeah, go ahead.
Intelligence, and then I've owned this for about 2 years, and their shares haven't really gone anywhere. But the reason why I'm raising it is I actually think there's now starting to get momentum, as real momentum behind it. They're one of the sort of biggest experts in minimally invasive leak detection out in the States, and they operate a franchise model, 2/3 franchise, and they own the third themselves. And they help basically, insurance companies, homes, corporates, utilities to find difficult to sort of access leaks in all kinds of properties and in pipe work. And they basically do this across all sort of different diameters of pipe work. And what's really interesting here is obviously if they use acoustics, so they can precisely find out where these leaks are. So it minimizes the repair costs. It reduces the damage caused, obviously, for homes, which is why insurance companies like it. They've got specific skills in sort of swimming pools and stuff. But also in the UK, where they're based, they can use the same acoustic technology to identify blocked drains for stormwater, for sewage overspills. And we know the problem in the UK in terms of the utilities, basically having sewage going into reservoirs, into rivers and into the sea, etc. they've shared, basically the top line has been flat for the last couple of years on organic because of the weak construction market. But actually, if I'm right, I actually think this is going to change next year. And the long term sort of like, secular sort of like, tailwinds behind the industry are obviously water conservation, massively important into the States. Climate change with obviously all the storms, and just more efficient irrigation and stuff. And they only so when you put all that together, that's a positive story. Their net debt is only about 1.2 times EBITDA. Revenue growth for next year is expected to be 14%. Yeah, and that's a split sort of like probably half and half between organic and acquisitions. And currently where the shares are, they're only trading at 11 times PE and 0.8 times PEG for a sort of high quality, cash generative, low risk business. And as I say, I've owned them for 2 years. They've gone nowhere. But I think if you want a business that actually does real things, helpful things for homes, properties, and utilities around the world that hits obviously all the environmental things, I think you can get it really cheap here. I don't know what you've looked at it at all.
Yeah, I followed this one for donkey's years, and I mean it was a major multi-bagger.
Yeah.
Going back sort of 5 years ago, wasn't it? Got to a ridiculous overvaluation, I would say, in 2021, but lots of things did. It's a distant memory now, isn't it? So looking at the chart, it peaked at around, what, £12 a share. I didn't understand the valuation at all. I mean, it was on a PE of 40 or 50 or something, but it's now come all the way back down to about £4 a share. So it's lost 2/3 of its value. And as you say, the forward PE now I've got 12.3 times. There's no tangible asset backing as such, but I don't think there's any significant debt. Doesn't pay divvies, that's the only thing. And it seems to quite frequently acquire franchises back, which worries me a little, because that's saying to me, well, maybe the franchise model doesn't really work that well. But no, I think it is a decent company. It's profitable every year. It's growing its profits, and the valuation now looks, I think, perfectly reasonable. 77 million market cap. So yeah, that gets a thumbs up from me, Paul. I think it's a good stock idea.
Yeah, well, I think next year you will see that top line moving ahead, which will be the real sort of trigger for it. And I think from last year they do a sort of like it's a bit slightly late, a sort of Q3, Q4 trading update at the beginning of December. Okay. So we might find what's happening in the ground. But they did buy a Dallas, as you rightly say, their Dallas franchise a few weeks ago. And anyway, it's all I would say is that I think it's a lower risk type of I would not be surprised if these shares double in 3 to 5 years, because with the growth and a re-multiple. But
I think that's not an outlandish suggestion. It's owner managed as well, isn't it? Patrick D'Souza owns 25%. Rather strange being listed in the UK, but I think that's because it's basically an American business.
Yes,
I think it's too small for the US markets. They don't really do valuations this low very much, do they?
Yeah. Okay, good. We've got a question coming in. We've got plenty of questions coming in. We've got IC4652. He's asking about Beeks Financial. Any quick thoughts on that? Because I know you quite like it, don't you?
I like it a lot. Yeah, it's my third biggest position. The cloud stock exchange, cloud connectivity business. Yeah, I think it's really special business, actually. It's now profitable and cash generative, fabulous organic growth. And it's just winning these landmark clients, one of which is believed to be, in fact, we're almost certain, is NASDAQ, but they haven't been able to announce it. So no, I remain very bullish on Beeks. I think it's a really exciting growth company. Yeah.
Yeah, good.
How about you? Have you looked at it?
Yeah, I mean, to be honest, guys, I missed it. I like it. And I mean, you just can't argue with the top line growth and the contracts and the customers. I think we talked about it some time ago, and they won that, what we think is NASDAQ. And when when you can win probably one of the biggest and certainly the most sort of like well-known stock exchange in the world now, with obviously, TES, with the likes of Nvidia and Microsoft and all the Mag 7 on it, then it says everything about the quality of the company, particularly for a UK company to win it. Is just,
I know,
it's just incredible.
It is, and I mean, on the Gordon MacArthur, the CEO at Beeks, does quite a few. I've interviewed him actually a couple of times, and he does investor meet company webinars quite frequently and so on. And I like the way he just tells it like it is. Very straightforward um, guy, and again, an owner manager who created this business himself, and it's just growing like a train. And he's actually quite excited about the sort of tier 2 or tier 3 even stock exchanges, because the Johannesburg one has gone very, very well, and they've now doubled up because they want full latent, not what do you call it, sort of backup
Yeah,
services. Which I was discussing this with a lot of IT guys at Mello, funnily enough,
mm,
fellow investors who are IT specialists, talking about Beeks, and I said, so what do you think about Beeks? And they nearly all said, oh, it's my biggest position. It's a pretty interesting company.
yeah.
So yeah, I like it a lot.
Good. We've got another question coming from one of my favourites, Paul the Parrot. He's asking about Shearwater, which I think is it a cyber security company? I think
Yeah,
sort of like it's a
very small.
consultancy, isn't it? I think.
It's tiny. Yeah, 8
Yeah,
million market cap. That's just below my cutoff. So I did see it put something out recently, didn't it, in the last week? Maybe that's what the other Paul is
yeah,
referring to. I didn't look at them though. It was just a little bit
yeah.
too small, and I've been full of cold this week as well. So I've only been operating on about 50% at best efficiency.
You've been doing pretty well on 50%, that's for sure, half a tank. All I would say about Shearwater myself is that it's a consultancy in cyber, it's actually quite a competitive area. If you've got
Right.
software in sort of like cyber, then it gives you a much more of a sort of competitive advantage. But
Yeah.
I think it's just anyway. All I would say is that for a small company to win in that space, they've got to have something special, in my view. But
Yeah, that sounds sensible. And its historical track record is not great. It's had several big loss-making years. It's never really made any significant profits over the last 5 years. So, yeah, I'd need to be convinced that there was something worth. If Paul the Parrot thinks it's good, drop us a comment and explain what the
yeah,
bull
no, good
points are.
point.
Happy to look at any company with fresh eyes if the facts have improved.
Yeah. I've got a question from Kev Allen, just briefly asking about sort of retailers. He's got B&M European Value and Fraser's Group for sort of like what the sort of prospects, because obviously they've got lots of quite a few cross currents here, because obviously the consumer is is still fairly stretched, but actually having positive real income increases. But we do
That's
have
right.
with the retailers that increase in the NI employers all coming through next year, which is going to be
Yeah.
pretty tough to absorb.
It is, and of course, it's going to be inflationary, isn't it? Because
Yeah,
all the companies being hit by this will be looking for ways to raise their prices and shrinkflation. Well, actually, I'm grateful to him for flagging B&M, because it's a business I do like. I think it's very good. I hadn't noticed that the shares have dropped such a lot this year. So it's down at only £3.45, which is a forward PE of 8.8 times, 7.1% dividend yield.
wow,
Um, yeah, it's a very interesting business, B&M. It's got these absolutely gigantic shops just selling a seemingly random collection of goods that they flex according to whatever deals they can get. So very entrepreneurial business. I like it. I think if you look at the top line, it will have doubled its revenues from 2019 to 2026. Makes a reasonable profit margin. Yeah, I think B&M's a good business actually,
yeah.
worth having a look at. And your lovely divvies, 6-7% divvies. Yeah,
It's the
good.
share price is really sort of like it's a ski
Yeah,
slope, isn't it? It's incredible.
it is. Yeah, so I mean, obviously, I'd have to get up to speed on the latest results statement, which I haven't read. So there could be a
Yeah,
good reason for why the shares have done that. But
yeah,
that's reflected in the broker forecasts, and your forward PE 8.8 is pretty cheap, isn't it?
yeah. Okay, good. Let's switch sectors. We've got Macfarlane. We talked about it
Hmm,
briefly last week, but it actually came out with some result or a trading update, I think it was, wasn't it? And the
it
shares,
was.
if I remember, the shares dropped slightly this week.
Yeah, it barely moved actually on what was, quite a soft update. They said volumes and pricing were both down. Um, and I think the broker just slightly trimmed the forecasts for the current year, but you're only looking, I think, again, I'm doing all of this from the top of my head. I think it was only about 3 or 4% reduction in forecasts, and the market shrugged it off. I like that, because that says to me you can see it's already fallen an awful lot from the high back in the spring. And so when you get a very mild profit warning and the shares don't budge, that to me is quite a bullish signal. That says there's no more sellers left. So I really like this one. I mean, I admittedly, I've been wrong on it for quite a while now. I've been bullish on Macfarlane for about 2 or 3 years, and it hasn't, it's given it's one of those shares that puts in a nice gain and then gives it all back. And then it has another little run and then it gives it all back. So it's quite a depressing share to own, but you get a reasonable dividend yield, 3.7%. Forward PE is now only 8.5. I think that's too cheap. I mean, admittedly, it's only a distributor of specialist packaging, so you wouldn't put it on a particularly high PE, but surely it could be valued on 11 or 12 times. I mean, I think 8.5 times is undervaluing this by 20 or 30%, I'd say. And his long-term track record is fantastic. They've done a lot of bolt-on acquisitions, so they're a sector consolidator. So I'm green on this. I remain positive on it.
It's got a lovely balance sheet, because I think, hasn't it, or something's got a very good balance sheet? I don't.
It's an okay balance sheet. I wouldn't call it lovely. Yeah, it's okay. Yeah.
All right, cool. But one stock that I own that again came out a result that I think are worth highlighting this week is Essensys, which came out with full year results, if I remember rightly. Yeah. And this one basically does flexible office software. It's been in a really tough space for 2 or 3 years. It got listed in 2021, and it basically does the hard to sort of cover. It's like very complex multi-story offices with all the software, and the idea is that it improves sort of space utilization, room occupancy, and productivity. And the big sort of move, the sort of a strong secular tailwind is as obviously of employers moving towards a sort of more hybrid working, and then you get temporary lets, flexible offices, better facilities, and it focuses on sort of your major landlords, your CBREs, your great, Portland, well, basically the, Blackstone, JLL, etc. So those are the sort of it's got a great client list, but it's obviously been trying to walk uphill for the last 2 or 3 years, spent a lot of money. But now I think we've reached a point whereby the housing, the property market, the office property market is actually improving, and we've seen that through from a lot of the landlords like Great Portland Estate, Regis, and CBRE have all been saying that is now turning, and they do about sort of 20 million of ARR, and the market cap's only 20 million, so they trade at about one time sales, and their sort of drop through gross margin is 60% plus with the sort of the software. They have some sort of net cash. They're not profitable, which is why the shares have been still pretty weak. But I suspect they're now reaching a sort of a turning point. Anyway, I've owned them for a long time, and I've been remaining quiet on them for a long time because they've just gone one way, as you can sort of see from the chart. But
yeah, it's been a disaster, hasn't it?
It has, yeah. But actually, when you say, in terms of bad news priced in, I think Richard Crowe of Cockney Rebel talks about bowls, and I suspect we've now reached a sort of bottoming in process in this. And for a private sort of transaction for a business like this, it would go for sort of 3-4 times, for a prop tech business, 3 or 4 times sales. So I think there's a lot of potential upside. Only sort of raise it. It is a high risk, high reward, no doubt about it.
I'm going to say, yeah, this is high risk, this one. I mean, on the 30th, I looked at it on the 30th of April, a reduced loss, and it had burned through. It had 3.5 million cash left, which a year earlier was 12.6 million. So it's burnt through cash at a breakneck pace. So this is really a bet on it managing to stem the losses before it runs out of cash. Do you know what the current cash position is, Paul? I haven't looked at it recently.
Well, in Q4, the last quarter, it was cash positive. Okay.
Okay.
And the reason, but if you stripped out the R&D credit it got, it was about 0.4 million pounds negative in that Q4. Now with a growing top line that gets obviously paid up front, I think there'll be EBITDA positive in the first half of this current financial year, and I think there'll be cash positive in the second half. And if you put all that together, the brokers sort of like, I think it's Singers, is expecting it to go from the year end to year end from 3.1 million net cash as of July, I think it was, to 2.5 million net cash by the July 25. So it'll what I suspect is just say there isn't that much wiggle room. However, having said that, given the level of recurring revenue streams, I'm pretty sure if they needed to raise, they could raise. But I think the more importantly, I think the global picture, the tailwinds in terms of people coming back to offices, working from home, and people wanting more flexible space and better facilities. These guys do it, and they've got the biggest customers in the market to prove it.
Yeah, no, sounds interesting. I'd be prepared to have a fresh look at that. But all I would say is that based on the historical numbers, it's been an absolute car crash. It is owner managed though. Mark Furness owns 30%, so he must be the founder. And what you often find, not always, but you do tend to find owner managed businesses rarely go bust. They normally they'll pull all the levers they have to keep the thing going. And he is stemming the losses very significantly. So yeah, I'll make a note of that and I'll have a fresh look at it. Thanks for the idea, Paul.
Yeah. Okay, good. We've got a question coming from Michael Evans asking about Supreme, who came out with results this week. And also they made a small announcement. They were looking at Thai food tea to potentially buy them out of administration. I mean, I looked from my take that they've got top line growth. And they upgraded expectations for the rest of the year as well. I think it was 240 million turnover they're looking for the full year. And I think it was, I can't remember exactly, 40 million of EBITDA, I think. Strongly cash generative. They're very, very cheap still. I mean, obviously, because they do about 60% of the company is vaping, and then the rest of the business, 40% is soft drinks, batteries, lighting, and I can't remember what the final one is. But I don't know if you've had a look at this one recently at all. They, as I say, the results were very good.
Yeah, no, not recently, because I just don't want to touch it because of most of the profit comes from vaping. So that I know there's no point in us getting into that because we have different views on that. So it's fine. But no, I haven't looked at it recently, Paul. I mean, the figures look attractive. Yeah, so it's purely down to whether you want to get involved in vaping or not, really.
Yeah. I would say that, on an 8.5 times PE ratio, they're still, and they're generating so much cash, then on a financials basis, they're very, very cheap indeed. And
yes, I agree. Yeah, absolutely. No, but looking purely at the numbers, yeah, it looks great value. I agree.
Yeah. And if they can pick up Thai food tea and then have a plan to be able to integrate that, that'll make more of because it's obviously Thai food tea is a big business. It's not small. It's number 2, I think number 2 operator in the UK, and we all know the UK love tea. So the sales must be quite heavy. And if they can pick that up at a good number and then integrate it and make it profitable quickly, then it could be quite transformational for them actually. But it's easier said than done.
It is. And I mean, I generally like deals where you buy assets off the administrator because it's a great way to pick up a business dirt cheap with no baggage because you leave behind all the liabilities. So yeah, it could be interesting. That's I could do with an O, isn't it?
Yeah, that's right. Okay, good. Let's move sectors. Let's actually go back to the building sector. We've got James Latham, which I think is a timber, basically does timber, doesn't it? Frames and stuff like this.
Yeah, I got this completely wrong. I don't know why I had it in my head they did fence panels. But one of the readers put me right on that, said, oh, Paul, it doesn't really sell fence panels. It sells panels. And I think it was the word panel, wooden panels. I just had a brainstorm and thought it was fences. But apparently, I had a look at their website. They sell all sorts of different timber products. Lovely business. Great. Again, family owned. love family-owned businesses because they tend to be run very conservatively for the long term. This one's got a staggeringly good balance sheet.
Yeah.
You're only paying 1.1 times tangible book. It's just got huge amounts of surplus cash and working capital in there. It's only on forward P of 11. So yeah, I wrote a positive thing about this. It did warn on profits, but it was only a very mild profit warning, and it did that sharp spike down first thing, but gradually recovered a lot of its poise for the rest of the day. So yeah, I've done an article on James Latham this week, and I concluded positively. I think it's good risk reward. They are suffering a bit. Their profits were down and the margins were down because apparently EU deforestation regulations are causing African, I think it's hardwood vendors, to dump their products into the UK,
Wow.
which is undermining margins in the sector, apparently. So,
Yeah.
but look, Latham's is still very nicely profitable. I think it's going to do about £1 per share EPS in the current year,
Yeah.
which would put it on about 11, 12 times. And when you adjust out all the surplus capital on the balance sheet, it would take you down to a PE of about an adjusted PE of 7 or 8 or something for a great, well-run business. They're going to open a new national distribution centre as well to more efficiently manage all their stock and then supply their individual depots from there, which will give a broader product range. And again, I'm sure they'll just buy a big plot of land and build a factory on it because they've got the capital to do that and self-fund it. So very, very nice business. It's one of those things to just buy and hold forever, I think.
Yeah, it's a family-owned one, isn't it, James Latham, I think?
Yes,
Is that
it
right?
is.
Yeah,
Yeah.
okay, yeah.
Yeah, it is very, very conservatively run. You've got a 3% dividend yield. I have a feeling they might have done a special divvy quite recently as well. I mean, if you look at the chart since 2009, I mean, it's 12 or 13 bagged, which is not bad. You wouldn't expect that for a timber merchant, would you?
Not quite, no. That's on fire, that is, to read the pod.
Yeah.
I know. Okay, we've got a comment from Andrew W about your Kingfisher thoughts, and he agrees. He says buying opportunity, so he's on the same page. Lemon Physical's asking about Spire Healthcare, which is obviously the private healthcare provider that Harwood basically there's quite a few in the Harwood. I think Christopher Mills likes it, and Odessian likes it as well. I don't know if you thought on that one in terms of obviously it's a massive waiting list. And anybody who's needs a hip replacement, knee replacement, or anything like this can't get that operation, and they're in pain, so they can't get into the NHS, and therefore they're getting Spire are benefiting from a number of individuals now going directly to them and doing almost pay as you go, actually.
Yeah, makes sense. It's not one I've looked at in detail. I can't really remember anything about it, but the headline valuation figures look reasonable. 15 times forward earnings, small dividend yield, some asset backing. There's a strange chart there. If you look at the chart since 2021, it's just sort of zigzag sideways in a quite a narrow range. I don't know why that would be, but yeah, I haven't really got any insights on this one.
Yeah.
Yeah, strange. So, but yeah, looks all right.
I know when I last spoke to Christopher Mills about Spire, he's pretty certain over the next 2 years this thing's going to get taken out by private equity or an overseas trade buyer because it's got effectively it's a trophy asset. You can't get these type of businesses very often. They don't come around like London buses. These things are sort of like one and you've got it and you dominate the market.
Yeah, and looking at the shareholder register, they've already got a 29.96% shareholder, Mediclinic International. So I don't know who they are, but when you see somebody jammed up just below the 30% threshold, quite often they can be a buyer for it, especially with a name like Mediclinic. Sounds like and then you've got Tosca Fund are in for 18%. They're quite activist, aren't they?
Yeah.
And Fidelity. So you've basically got the top 3 shareholders own about 60% of it, which again means that some sort of deal is quite likely, I would say. Yeah. So yeah, quite an interesting one. Worth a look, I think.
Yeah, I think if you're patient, then you can't. The only potential downside I would say is that if the Labour Party got particularly aggressive on private healthcare and say introduced VAT on private healthcare fees.
Oh,
But
right, yeah.
they'd be cutting their own throat with the NHS if that's the case, because they just can't deal with the volume from private health, you know.
Yeah, I mean the Blair government, of course, made widespread use of private health
Yes.
providers, didn't they, to get the waiting list
Yeah.
down. So that's a sort of well-trodden path for Labour. So maybe it could benefit Spire Healthcare. I don't know.
Yeah. Good. Okay, we've got one coming in from Learn, Teach, Learn. I'm not sure that's a Trump analogy, but anyway, he's asking about Evoke, which I think is the old 888.com
Yeah,
casino. And they bought William Hill, is that correct? And they've got a shed load of debt, if I remember correctly.
yeah, I think that's the one that is basically insolvent.
I was see.
Yeah, no, I mean, no, it is. If you look at the balance sheet, that's the one with, yeah, here we are. You've got a market cap of 254 million,
Yeah.
enterprise value of 1.8 billion.
Yeah.
So yeah, that's uninvestable for me. But of course, if you like higher risk situation, I have looked at this one actually, and I just couldn't see how it could possibly survive, let alone pay off the debt. So
Mm.
that rules it out for me, the balance sheet. But sometimes these super high risk things, if they do manage to find a route out of the debt, the benefit all flows to equity, and you could have a multi-bagger.
Yeah.
But looks, yeah, very high risk, I think.
Or alternatively, one of the bigger boys, Entain, or one of the other mega sort of like casino operators who've got a lot of, because they generate so much cash, decide to just put a number on it and just take the debt out, because obviously it's
Yeah, could
expensive
be.
debt. But if they just refinance the balance sheet, you then get all the pure cash flow straight through it. I mean,
Yeah, I mean,
I'm with you.
yeah, I mean they could do that, but the worry with that type of situation is that the buyer wants the debt holders to take a haircut,
Mm,
and maybe will give them 70p in the pound, which of course means the equity is totally wiped out, doesn't it?
yeah.
That could be the end game there, or a debt for equity swap that leaves the debt holders with 90% plus of the business. So I personally, I wouldn't touch equity where debt is effectively in control.
Yeah, I mean, I'm with you. I think there's easier places to make your money, to be perfectly
Yes.
honest. But
Yeah.
and one of them may be this actually. We got Emmanuel asking about Anpario, which I think is a
Oh yes, I like
it's
this
basically
one.
it's a natural ingredients and digestive sort of like, I think, products for animals, isn't it? I think.
Yeah, it
It-
is. It's always struggled to scale up. It's a very small niche business, but I can't remember any details, but I have a feeling the latest news from them has been pretty good,
yes.
actually. Uh, and one of the readers flagged up something about it, saying that I think the broker forecasts were too low, or included an amortization charge that they shouldn't, or something like that.
Mm,
In other words, there was hidden upside on it. So yeah, I've got a positive impression of Anpario, but I can't really remember much in the way of details. I think it's got a good balance sheet. Forward PE, yeah, 13.6 is quite reasonable. 3.4% dividend yield. If it can really scale up, then you'd be doing very well. And it's had some pretty good previous highs, hasn't it?
mm.
So yeah, I've got a positive impression of Anpario. Is it one you've looked at, Paul?
Yeah, I thought it was a high quality business actually, and the shares have re-rated, and I don't know the exact sort of multiples on. I'd have to put the slide rule over it, but
Hmm.
yeah, I think it's a good business in a good sector actually.
Yeah, it is. Its problem is growth. It just, it's been bumping along around 30 million revenues now for the last 6 years. So can it actually scale up? And I mean, the 2025 forecasts show quite big revenue growth. So if it's getting into a sweet spot where it's starting to accelerate revenue growth on good margins, this could be quite exciting. So yeah, I think that's definitely worth a closer look.
Yeah. Got a cheeky question from Guy Seaborn. He's saying there's about 10.8 million shares in Gulf Marine Services traded today. And have you any thoughts on
Oh,
that? Any thoughts on that at all? They've had
well,
some good news flow, haven't they?
yeah, I love this one. It's so cheap. I mean, I nearly bought some more today actually, but I spent my money on those REITs instead. So
Yeah.
yeah, around about 15, 16p, it's back in buying range for me. None the share price is just is goes where it goes, mainly because there's just an imbalance of buyers and sellers in the market. But the
Yeah.
figures are fantastic. This is a deleveraging
Yes,
story.
it is.
I'm a stuck record on this one, but you only have to look at the numbers to see the cash flow it's generating is incredible. Trading well below book. It's only at about half book as well, tangible book. And I had a Zoom with the CEO, very good Zoom with him not long ago, and he said, look, the vessels that it hires out are worth well above book because they're absolute cash cows. So you've got upside on the book figure as well. I mean, the valuation just doesn't make sense to me at all. But maybe I'm missing something. I don't know. So yeah, I love this one. I do hold some personally, and I'd be looking to top up.
Yeah, no, it's good. Okay, we got another question coming in. We got Kev Allen. He's asking about the recent purchase of 3 million shares or £3 million worth of shares in Marks Electrical by Mike Ashley of Fraser's Group. I don't know if
really?
Yeah, he seems to sort of like have his shotgun at so many different retailers, and it seems an odd one that he's going for Marks, to be perfectly honest, because I think it's about 60% owned by the founder.
More, I think it's about 3/4. 74% owned by Mark Smithson, which is far too high. You know, when they floated it, you can't float things with the founder owning 3/4. It's ridiculous. So I'm actually very underwhelmed by this company. It floated a few years ago, you know, kind of making out it was lean and efficient and, you know, all the rest of it, and was making good profit, but the profits have just slipped away. But it basically doesn't really make any profits now. It's had a bungled ERP
I heard that as well.
system. So no, I've totally lost interest in it. I think it should probably delist. It's not, the story hasn't played out as we were told. And Mike Ashley can't do a thing. You know, if he can buy the whole of the other 26%, and he still won't. You know, he won't be able to use his sort of bullying strong arm tactics that he likes to use. It won't work, will it? He tried that at Mulberry, of course, where he had a controlling shareholder and they just told him to sod off. So I would imagine that Marks Electrical will probably probably say the same thing.
He likes to rattle a few Ks, doesn't he, Mike Ashley? I mean, he's done it with Boohoo, and he's done it with Revolution Beauty, and there's a whole bunch of ones he's got big sort of like positions in.
Yeah, very strange man, very strange strategy. I just always have this feeling with Mike Ashley that it's all going to end badly. I can't, because I think he's just so reckless and so overconfident. And look, he's achieved amazing things in his career, clearly, but it's obviously gone to his head, and I'm not sure he necessarily makes good decisions.
You could either view that as dangerous or what we need in the UK, a bit more entrepreneurship. But
yes, you could argue either way, couldn't you? And you can't argue with what he's done with Sports Direct now. Fraser's, you know, he's.
We've got a question from Kaushik. He's asking about Getech. He says it's a nano cap. I think it used to do oil fill services on an information basis to do seismic data for.
I looked at this one many years ago, and it just goes nowhere, does it? So it's not a story I would be interested in revisiting. 3.3 million market cap. Too small to be listed.
No, I would agree. Yeah, no, I wouldn't go for that one. One from where is it? Yeah, Paul. He's asking about Avingtrans. I mean, I love this company. I don't know if you've had a look at it. It's basically a engineering business with a sort of twist, a medical twist on the side of it, and the medical twist is MRI and 3D X-rays, which they're commercializing, which is heavily sucking in cash. But the massive amount of cash has been generated by the underlying engineering business, and you need to value it on a sum of the parts. And if you do that, then Singer's did on the just recently. They've got a sum of the parts for the engineering business. If I just from the top of my head, I think it's 525p, and then they've also got the medical side at about 200, I think is the midpoint. So you get about 725 on their sum of the parts. But it's one of those things is such that. You know, you've got to trust the management team who have done a fabulous job. I'll show you the chart of the century here, actually, Paul, if you've ever looked at it.
I know this one quite well. I've just been looking at the long-term chart. I mean, you know, you're more than a 10-bagger, aren't you?
Well, yeah, I mean, it's done over 20% per annum for the last 15 years.
No,
Just
they're generally regarded as very capable, I think, the management here, and they do a lot of corporate transactions, don't they?
yeah,
Sort of buy things and turn them around. I don't really have any current view on this one. I haven't looked at it recently.
yeah.
Yeah.
No, as I say, I think you'll see some good news flow come. I did speak to who was it? Judith McKenzie of Downing, actually, a few months back, and she was very
Yeah.
positive on the realization of
Okay.
this business. So there's multiple ways they could get value from the medical, and I suspect it'll be spinning it into a joint venture, selling it, or even IPOing it separately.
Okay. Yeah.
So there could be a lot of good positive news flow. Got one
Yeah.
from Christopher Archer asking about Alpha Group, which I think is a payments company. Is that one which is the really big one? I think there's a Morgan.
There's a couple. There's Alpha Financial Software, or there is.
I
Isn't there
think
Alpha with a PH? I'm not sure which.
I think it's the
No.
Alpha International which is the.
What's the ticker?
I don't know. I'm trying to find it actually.
Ah.
That always is. Here it is. Alpha Group International. Ticker is ALPH.
Ah, yes.
Morgan Tilbrook, I think is if I remember rightly, is the CEO. It's one of those. It's an international forex payments company that is really the poster child of the sector. And I think it's on about 5 or 6 times sales. Margins are really good, and they've got a really good software suite associated with it. I mean, Christopher, for my knowledge, if you own it, I would just say stick with it. The guy's done a fabulous job, and it's generated lots of cash. But
no, I can't. I don't think I've looked at this one recently.
yeah,
Looks maybe fully valued. Oh, here we are. Yeah, I did have a look at it on 10th of September. Oh, that was just the CEO succession.
yes,
Being replaced by the current chairman, and dropped 13% on that news, which was quite. And then I looked at it again on 4th of September. 1 billion market cap. H1 profit up 14%. July and August were good, and reasonable confidence full year will be in line. Here we are. I've just concluded. Looks quite interesting.
yeah.
Yeah.
No, it's a good business. Okay, we've got just time for one last question. It's a large cap actually. I don't know if you ever covered it. Is from Emmanuel. He's asking about GSK. He's asked for it twice.
No, that's way out of my my league. So no, I haven't got any of that. GlaxoSmithKline, isn't it?
Yeah, GSK. Yeah, I mean, all I would say about Glaxo, I mean, I've looked at this many a time, and the shares have obviously, I'll just put the chart up here.
Gosh, the PE is very low, isn't it? 8 times, a 4.8% yield.
The shares, unfortunately, have gone nowhere for about 20 years. And what happened? They made a couple of strategic errors. They got out of cancer, and then they sold it to one of the big European oncology providers, and then are now trying to get back into cancer. And then they span off, obviously, their consumer healthcare, which was a good move under a lot of pressure. And so at the moment they're now a vaccine business and a oncology business with a few other things. The vaccine's very good quality. They've got Shingrix there. Which generates, and their oncology business is actually getting a lot better. The reason for the recent weakness in the shares is because Trump came in and basically recruited the new guy to come in to be the healthcare secretary who hates vaccines, and therefore, if they're a vaccine manufacturer, they won't help them. All I would say is that it's a cash monster. It's generating a lot of of dividends, and it's cheap in the valuation. It all comes down to your view of what their product portfolio is like and their drug discovery. And if you're happy with their oncology side and their vaccine side, then it looks like an absolute no-brainer. But for me and you, looking outside in, it's a black box. We don't know which one's going to be the best one.
But, exactly. And these things have a certain life for each drug, don't they, before it becomes generic and everything. So no, much too complicated for me. So, but I can see just purely on the headline numbers, forward PE of 8 and 4.8% dividend yield looks attractive, doesn't it?
Yeah, good. Okay, well, thanks again, Paul, for your time. Thanks everyone for your questions. Again, I just want a big shout for our goodmoney.com, sorry, goodmoneyguide.com sponsor, who, if you put some reviews onto their website, you can get a discount, 50% discount, and you might even put yourself in for their £500 Christmas bonus as well. So thanks a lot then, Paul, and look forward in chatting about chatting next week. Thanks very much.
Lovely. Have a good weekend, everyone. Bye.